Hello and welcome to a brand new episode of Smart Money. Now on the show today, we'll tell you how to build a solid mutual fund portfolio, the common mistakes to avoid and the top mutual funds you can invest into amidst this market fall. My guest today is Kirtan.shah. He's the founder and CEO of Credence Wealth Advisors, which is a boutique wealth management setup focused on advisory services around equity, fixed income, alternates and offshore. He's very popular on social media as well, and he's been around in the BFSI space for at least the last 14 years, having worked as a treasury head at an NBFC before starting on his own. Kirtan, thanks so much for being with us, and it's great to have you here in person.
Thank you so much for having me on the show, Sonia.
I think this is the first time that you're coming into our studios and the first time we're meeting in person, right?
Very much. I would have done 20 plus shows, but I'm glad that we're meeting for the first time.
Absolutely. And you know, this is, I guess, a great time to be talking about investing because of the way the market has fallen. Of course, it's created a lot of jitters, but I guess the best time to buy is when the market is fearful.
Absolutely. I think the longer time frame that you have in terms of your investment, all that you have to do to beat the best of the money managers is stay invested as long as you can and try and buy every dip. If you're able to do that, I think you'll be able to beat 9 out of 10 of the best guys on the market. Okay,
and we also know that investing just purely in an index fund also helps you beat most of the money managers. But you know, the reason I'm having this show today is because we want to discuss some things to do with building a core portfolio, strong core portfolio for the future, right? A good corpus. Let's start with the common mistakes that you've seen investors make, and what are the mistakes that I should avoid while trying to build a portfolio?
So Sonia, like you are aware that, you know, most of us while trying to build a portfolio looks at diversification as the biggest advantage for which we really want to build a portfolio, right? But while I look at clients' portfolio when they come to me, I see so many of these same errors repeating again and again. To highlight a few, and I'm sure most of the viewers will really be able to relate to what I'm trying to say. So when I receive portfolios, I have some 20 to 100 schemes that the investor would have invested, thinking that more the number of schemes that they will invest in will bring in diversification. But unfortunately what happens is, Sonia, like you are aware, each scheme has 30 to 50 stocks. Now imagine if you've bought 20 schemes, right? You've invariably bought a BSE 500 portfolio, right? How are you really going to be able to reduce risk or generate better risk-adjusted returns? I think in my opinion, you don't need more than 4, 5 or maximum 6 schemes to really build a good diversified portfolio. That's point one. Second, also what I've seen is, Sonia, that while let's say if you have a 10 scheme portfolio, I've seen so many of these portfolios when they come to me, they have 6 schemes or 7 schemes of one particular category in which they invest. Okay. So imagine if you've invested in 10 schemes, 6 out of the 10s are large cap. Now, if you look at those 6 schemes in particular, you will see that there is so much of overlap, 70-80% overlap.
Duplication of stocks, right?
You ideally don't need those 6. You need one of those 6 probably.
Okay.
Right? Another common error that I see, and I'm sure you will relate to, is that there are periods where a couple of these AMCs become popular because of their performance in the near term, right? It was some AMC 10 years back and different AMCs right now, right? Now we've seen that out of those 10 portfolio schemes that we are talking about, right? Because these AMCs are popular at this point in time, some 5, 6, 7 funds of that one particular AMC is what the investor invests in, right? So you will have a large, mid, small, flexi, everything of the same AMC that they've invested in.
So that's a mistake. They should not do that.
Big mistake.
Okay.
In fact, a bigger mistake than that, Sonia, in my opinion, is that most investors today look at the last 3 years of return and then start investing, right? Not understanding that a particular theme probably is played out because of which that particular fund has performed so well, and it may not consistently keep happening. You look at NASDAQ for an example, right?
Yeah.
Now, 3 years back, I never saw anybody wanting to invest in NASDAQ, right? It was not a very popular kind of investment opportunity. Today, everybody is either wanting to invest in NASDAQ or already has invested in NASDAQ, right? So okay,
let's pause. You've given us many nuggets, right? So one thing you said is don't have too many schemes. I think ideal is 4 to 5 schemes in your portfolio. Don't have all the schemes from the same AMC. Diversify into different AMCs so you're hedging your bets. And the third thing you said is don't have too many of the same category. So if you have 5 schemes, for example, which is an ideal portfolio, right? How do you break that up? How much should be in large cap? How much in small, flexi cap?
So in my opinion, ideally you should typically try and avoid going for a probably hybrid product like a flexi or a multi-cap, right?
Okay.
In my opinion, a equal weight portfolio of a large, mid, small will make a lot of sense, right? Because if you look at, let's say, a large cap or a flexi cap portfolio today, flexi cap portfolio is a pseudo large cap kind of a portfolio. You pick up any flexi cap today, you will see 70-80% large cap, right? When you are talking about multi-cap is a pretty new category, and in my opinion, there is too early for us to be able to figure out whether multi-cap will really perform the way we are anticipating it to. In my opinion, equal weighted portfolio across large, mid and small will make a lot of sense.
Okay, so just stick to the pure vanilla, plain vanilla large cap, small cap and mid cap funds, right? All right, now since we're talking about how to build a portfolio, what are the key parameters that you look for before building a portfolio?
Sonia, I think that's a very interesting question, because I think this is really what I want to convey to the audience who's hearing us today. So there are 4 things that I really look at while I try and build a portfolio. First, we've already spoken about, right, which is market cap diversification, right? Do not try and go overweight on a large cap, mid cap, small cap, looking at the last 3-year, 5-year, 10-year data, right? If you look at the last 10 years, you will see that 5 out of those 10 years, small caps have been topping the chart, right? And invariably, that will entice you to invest in small caps. But if I give you a specific point in case of 2018, right, small caps were down 23%. And in the same year, you had large caps positive 6%, right? So you don't know who the winner is. Winners will always keep rotating. So my first idea is to try and make sure that we are invested across large, mid, small. Okay. That's on the market cap diversification. The second very important, in my opinion, is we should look at geographical diversification.
Okay.
Right now, suddenly it's become popular, but there are 2 things that I really want to convey. So let's broadly break this down into emerging markets and developed markets. So while you talk about emerging markets, I think because of whatever is happening in China, right, everybody is pulling out, and there is no better place to stay invested than in India, right? So there is not a lot of things that you will really have to do while you talk about emerging investing. But there are certain themes, like say, for example, a semiconductor or an EV, where we might not have a lot of opportunity to invest in India to play those themes. So while you do geographical diversification in the emerging space, probably you can look at some thematic investing across China, because you can't play that in India.
But these thematic investments are very temporary, right? Don't you think? I mean, for someone who's looking for a long-term portfolio, these themes play out in 6 months to a year, and then what?
Absolutely. So let me give you an example of the developed market to answer this and link this a little better. Now, while you look at the developed markets, you will see the European region's done nothing well, right? Last 3 years is negative, 5 years is almost flat. Now, if you look at US, right, the last 3 years, the cumulative return of S&P would be close to 30%. Now, of that 30%, roughly 45 to 50% is FANG, right? That's the kind of return, right? So now, probably we might not have those deep tech kind of plays available in the Indian context, because we are largely more service oriented on the tech side, right? But that can be one play that somebody wants to play, because it probably is a long-term play, because the world is moving towards digitization, right?
Okay.
So there may be some themes that probably are not very, very near-term, but can be a larger play that you can really include while you're trying to build a portfolio. So that's a little on the geography front. Third is very important, Sonia, in my opinion. While we are trying to build a portfolio, most of us don't look at the style of investing, right? So if you break down the entire AMC space, you will have a lot of fund managers who are following value style. You will have a lot of fund managers who are following growth style, right? Now, all of us know that growth works in some cycles, and it is value that works in some other cycles, right? Now, as a retail investor, it is so difficult for us to be able to figure out when does value work and when does growth work, right? But if I have to give you a larger context, whenever probably the markets are expensive and you want to invest new money, value will do well, right? But at the same time, inversely, when the markets are not a lot, there's not too much of high valuation in the market and you want to infuse more capital, probably growth will do well. But as a retail investor, it's so difficult for you to figure out what is highly valued and when will value work.
Exactly. That's what I was going to ask you. I mean, how do you really figure, right? Because as someone who's perhaps been tracking the market for so long, even I can't understand when I look at mutual funds, what are value stocks, what are growth stocks, and how do you understand when to catch the cycle?
So two things. First, because you generally as a retail investor will not be able to do it, try and have both in the portfolio.
Okay.
Point one. Point two, let's say if you want to figure out when does what work. Like I said, largely in my opinion, if you look at the last 10-15 years, you will see this play out every time. Then whenever the market valuations are slightly higher, right, you will typically see new money going towards value. Is because it is so highly valued, the growth stocks, that you don't know where to put money, and hence value starts working. And inversely is where growth works. If I look at some data point also, look at last 1 year when the valuations were extremely high. Now, of course, it is hindsight, but just to explain, BSE 500 has given roughly 5.5% return.
Okay.
But if you look at the popular value funds in the MF industry, they've all given double-digit returns.
Okay.
Right? So, look, of course, as a retail investor, it is so difficult to be able to predict and understand when value works or when will growth work. So try and have both in the portfolio is what I would suggest.
Okay, so let me ask you a question on each of these points particularly, right? You spoke about market cap. Why not have an exposure to multi-cap funds? Because it's market cap agnostic, right?
Absolutely, but I'll tell you a problem there, Sonia. While you are trying to diversify, we spoke that you should not have concentration on one AMC, right? You split your money across AMC so that your concentration falls. Now in multi-cap, what will happen is, yes, the product says that I will invest in large, mid and small,
yeah.
but it is one fund house and one fund manager,
Okay.
right? But when you do a large, mid, small separately, you can really build 3 strategies or 2 strategies across 3 different AMCs, and that's how you will bring in the diversification, right? And largely, like you say, Flexi is very similar to multi in that context, right? It can invest everywhere, but it's largely a large cap fund than a Flexi, right? So I would rather look at Flexi as large cap, and instead of doing multi-cap, we can split across large, mid and small. Okay,
since it's so confusing, there's so many funds, there's so many categories, why not just plain invest in index funds? I mean, this is a debate that has been raging for a long time, but I think that index funds over a longer period outperform most money managers, right? So shouldn't the answer to everything be just go ahead and invest in index funds?
Like you rightly said, there's a lot of debate around that.
Yeah.
I have my own version of view that I would like to believe.
I would love to hear it.
So, like I said, that while you are trying to invest, momentum works in a particular cycle, and then your value works in a particular cycle, right? Now, the problem is index, in my opinion, is momentum or growth investing. Because how's an index formed? Whatever is working in terms of stock price or market capitalization is included in the index. Whatever does not work is kicked out of the index, right? So when you look at index, it's largely momentum or growth investing.
Yeah.
There is no value. So if you put all the large index funds in your portfolio, you've built a portfolio which is more growth oriented, momentum oriented, it will not have value. So such a portfolio would have not worked in the last 1 year.
Okay.
Because market valuations were high is when value as a strategy would have worked, right? So while you're trying to build index, right, I think hybrid is a better play.
Okay.
Index will bring in the momentum, and then you add a value style of fund on the active side, and that can be a good bet in my opinion.
So you can do both basically is
Yes.
what you're saying, all right. That'll help you hedge your bets,
Absolutely.
right? Especially in this kind of a market. Okay, let's do one thing. Let's take a quick commercial break, but don't go anywhere. We'll be back in just moments from now. We'll continue to discuss how to build a core portfolio, a strong portfolio amidst this market volatility. Stay with us. Well, everyone tells you what to do in a market, but we're going to tell you what not to do. The common mistakes that you can avoid while building your portfolio. Kirtan.shah, the founder and CEO of Credence Wealth Advisors, has been here with us, telling us how to build a sound portfolio so that you can have a sound sleep, right? that's all we try to do, I guess, when we try to create wealth for ourselves. But Kirtan, before the break, you were telling us about the common mistakes that one should avoid. I've heard this a lot, that one shouldn't invest in NFOs. Now, is that a big mistake that people make as well, and what is your thought on that?
Sonia, look, there are roughly 16 to 1700 schemes in the mutual fund industry today, right? There are at least 300 to 400 schemes, a little here and there, I might not be exactly right with the data, but there are at least 300, 400 schemes in the industry where you will have a 10-year, 15-year, 20-year performance, right? You would have seen that scheme go through 2008, 13, 14, 2020, they would have seen 3 cycles of ups and downs in the market, right? Now, while you have such scheme available in the market, where you've seen how these schemes did when the markets were not doing well, how did these schemes do when the markets were doing well, right? Investing in an NFO which has no background, right, and you have absolutely no idea of how this will play out when there is a downturn or an upturn that is going to come up the next, it does not really add a lot of value to the portfolio, in my opinion, right? There is a misconception, in my opinion, that investors think that they believe that the fund will find it easier to move from 10 rupees to 11 rupees, then move from 100 to 110.
Yeah.
Look, largely it's the same 10% movement that we are talking about, but this is mental processing.
It's that same concept where people like to buy penny stocks because they believe the value of the stock is lower, but that is like the biggest misconception, right?
Absolutely, right? So I think, in my opinion, you should do NFOs only when you've come across a theme or a product which is not available in the existing investment universe, right? That is where you would want to take a bet saying, you know, look, something like this is not available. I don't know whether, what and how an X scheme would have performed had the scheme been around, is where you take a bet on the NFO because you like that product and you don't have an existing product in that space. But if an NFO comes out where there are 20s, 50 funds available with 10-year, 15-year, 20-year history, I really see no logic of doing an NFO investment just because the NAV is 10 rupees.
Okay, guys, he's really, strengthened the case of not investing in NFOs, so don't make that mistake. But let's talk about the funds now, right? What can a good model portfolio for an investor look like? If I want to invest in equities now, because it's a great time, I mean, the markets are down over 15%, what are the mutual funds to look at?
So, Sonia, there are 4 things, in my opinion, that somebody should look at before building a portfolio, what we are talking about, right? Let me first tell you the funds that I'm talking about and then explain to you what are the logics of those funds, right? But of course, a disclaimer that this is a broader context, and personal finance is extremely personal to each one of us, right? It may not be applicable to 9 out of 10 people watching our show, but it largely cover the context of what I'm trying to say. So in my opinion, a Mirae large cap, a Kotak emerging equity, Axis small cap, and a PPFAS flexi cap, a 4-fund portfolio probably will be a very strong product portfolio. Let me explain to you why. So reason 1, in my opinion, like I just explained to you, instead of doing a flexi or a multi-cap, I would rather do a large cap, mid cap, small cap equal weight, right? So Mirae is large, Kotak is mid, and Axis is small. That takes care of.
And Mirai's performance has been good compared to its peers?
Very good.
Okay.
Right? So that's one.
Similar is the case for Kotak and Axis.
Absolutely.
Okay.
So that's case 1. Second, geographical diversification, right? And I was telling you how probably you can play some themes out, right? But I'll tell you a challenge with geographical diversification. In the Indian context, when you try and invest in a NASDAQ, that's considered in terms of taxation as debt investing. So when you do foreign investing, you are taxed at debt level taxation, right? So is there a way where you can do international investing, do theme-based investing that you want to invest and yet get equity taxed? So what you do is, there are Indian funds, Indian equity funds, where the objective is that they can invest a certain portion in foreign funds, right? Which is the case with PPFAS.
But there was a stoppage on that, right?
Yes, but I think that's just been 2 months. It probably might take a little more, but it'll open up eventually.
So one shouldn't, if you have an investment in PPFAS, up until now, one shouldn't stop your SIP.
Absolutely not, in my opinion. So what happens is, with PPFAS, you get the geographical diversification that you are really looking at, plus you get the equity taxation, which is advantageous, in my opinion. The third, we spoke about value and growth, right? This combination has a brilliant mix of value and growth, right? And the fourth that we spoke about is not trying to put all your eggs in one basket and one AMC. This will also make sure that you are not overly dependent on one AMC or one style of investing, and you are spread across 4 different, right? So it takes care of all 4, market cap diversification, geographical diversification, value and growth diversification, as well as not putting a lot of concentration on one particular AMC is also taken care of with this product portfolio. But like I said, look, this is largely at a macro level.
It's a template, right?
Yeah, it's a template. It's a template to try and put more focus on what I'm trying to say. It's going to be very individualistic depending on the risk profile and the time horizon that one really wants to invest. But largely, I think you don't need more than 4 or 5 funds in your portfolio. Too many funds will only add more risk. Over diversification is not going to add any value to the portfolio. A 4-5 scheme portfolio, probably with these 4 things that we spoke about, can be a perfect fit of a portfolio.
Okay, folks, so Kirtan has pretty much sorted us out, right? If you want to invest in the mutual fund, in mutual funds, and you're looking out for different funds, then he's made a template for you where he's talking about the Mirai large cap, the Axis small cap, and the Kotak Emerging Equity Fund,
and PPFAS.
Also PPFAS. All right, so for geographical diversification, those graphics will come up for you on your screen about the funds that you should look at. One final question before we let you go, because it's the hot topic of the moment, right? The rupee crashing, and with the way inflation is going, a lot of people ask how they can hedge against the rising dollar, purely because later on you may want to educate your child, send him abroad. And what do you do then? What if the rupee goes to say 100 rupees and 10, 15, 20 years down the line? So how do you hedge now?
So there are 2 ways of doing it. First, use the LRS and start investing in dollar terms outside of the country, right? Is because you are going to consume that dollar tomorrow for a particular goal.
Yes.
Right? So that is one way of doing it. Another way of doing it is the geographical diversification that we spoke about, right? So if you use the Indian mutual funds to invest in foreign funds, typically what happens is you don't only make the return that the stocks are going to make, but the rupee, like we know, has been depreciating at 3.5% every year. That also starts adding value to your portfolio.
Okay.
Right? So a rupee portfolio versus a dollar portfolio, the dollar portfolio will keep adding 3.5% more, assuming everything else is the same because the rupee is depreciating. So the best way, if you really have a goal, you should start investing in dollar denominated assets globally, right? Is because you are investing in dollar, you will receive maturity in dollar, and you can use that dollar for your goal.
Later on, yeah.
But otherwise, if that seems too complicated, I think start taking exposure to geographies where the investments happen in dollar, and you in turn earn that rupee depreciation in your investments.
Apart from PPFAS, any other funds that have geographical exposure?
There are so many of these funds, specifically in the flexi cap space now, that have come up with this. There are at least 10 to 15 funds that have come up with, looking at the success of how international diversification has really helped and worked out. I think the industry is moving in a direction where probably most funds will have their objectives changed, where international investing will be allowed.
Okay, we'll do a separate topic on that another day because we run out of time. But Kirtan, it's a pleasure speaking with you, and I must say your energy is infectious. I invite you yet again and another time to come and talk about several topics with respect to investing. All right, with that, it is curtains down on this special edition. Keep writing to us. We love receiving feedback from you. Until next week, same time, same place.